Hey traders, Philip Tigerson here from Stock Market Strategy. Before I start, I just want to say that trading involves risk and hard work, so please do your own due diligence before trading for real money. Today I'm going to talk about relative strength. Don't mistake this for the indicator called RSI. I will explain what relative strength is and then show some charts how to best use relative strength to improve your trading. Relative strength is a very powerful tool and is probably my single most important tool in trading. If you go to our website www.stock-market-strategy.com, you'll find a tab called Education, Technical Analysis and Relative Strength. Here you'll find a written explanation including 2 charts showing you how to use relative strength in conjunction with other indicators and chart analysis. Relative strength is not an indicator per se, and therefore it's often overlooked by many traders. In comparison a stock or any other instrument to another stock/instrument, and most commonly we compare, for example, a stock to a market index such as SP 500. Just like I've done here, I'm comparing Apple with the S&P 500. The calculation is quite simple. You simply divide the stock price with the price of the S&P 500. It gives us a number which we can then use to plot a graph underneath the stock, like I've done here. You can add any technical indicator or use any chart analysis on the relative strength if you want to. Here I've used a 150 moving average, just like I'm doing on price. You can also use the chart analysis, like saying you got higher lows and higher highs, higher lows, higher highs. Relative strength can give you a heads up on rapid changes in price. This is a main reason traders are using relative strength. Another reason is that traders prefer buying leaders in the market, so buying a stock that shows relative strength makes sense. There's no reason to buy a lagging stock which is only going up because the market is dragging it up. There is totally 4 scenarios that the relative strength and the price can make up. The first one here is that price are climbing and relative strength are climbing. There's 2 red arrows indicates that. That means the stock are climbing more than the S&P 500. Here's another scenario with price and relative strength. Price drops and relative strength drops. That means that this stock drops more than the S&P 500. These are the only 2 scenarios I want to trade. When I short a stock, I want it to drop and I want it to underperform the market. That gives me a higher odds trade and the chance of getting a higher profit. When I want to go long in a stock, I want the stock to climb and I want relative strength to climb, because this means my stock is outperforming the market, increasing my odds of profit and also increasing the amount of profit because it outperformed the market. Now I'll show you the 2 scenarios I do not want to use energy on. There's no reason for me to trade them. And here's the first one. Here you see a sector which is climbing. So you think it would be wise to buy stocks in this sector because it's in an uptrend. But that's not entirely true, because if you look at the relative strength, you see that it's downsloping, it's downtrending. So it shows relative weakness to the S&P 500. So there's no reason for me to buy any stocks in this sector or buy a stock which shows the same pattern. When it's underperforming the market, I might as well just buy the market and make more money. Here's the 4th scenario, and the second one of those I do not want to use my energy on. Here you see GLD. It's an ETF. It's designed to follow the price of gold. But you see gold making a double top here, taking out that neckline here, so it's a confirmed double top. You'll probably be looking to short the retracement up, this one here, at the MA. You think it's a good short. But the truth is, it's a waste of time and money, because you see that relative strength are climbing, suggesting that your money would have been better used on trading the S&P. This would have given you relative more profit. Okay, you now know that relative strength helps you choose the strongest stock in a strong market, and it helps you choose the weakest stocks in a weak market. By doing this, you increase the odds of success. Here is how you can use relative strength for entries. The first one is when relative strength shows divergence. It's when price makes a higher high, relative strength makes a lower high. This suggests that this high up here is not supported by the relative strength, and therefore it's an opportunity to go short. And in this case, I would use this bar here as my entry signal, because we open up here above the high over here. We then pull back underneath the high just slightly and closes on the low. That means it's weak. Sellers are coming in up here at resistance. The next day we open down here. It's a gap down, catching all the traders up here. So my entry will be on the next day when we have that gap down. Another way to use relative strength for entries is use it for confirmation of a trend. Here we see price makes higher highs and higher lows, and relative strength makes higher highs and higher lows as well. So you can use this for entries here and here because they're confirmed by the relative strength. You can enter these on many different ways. You can use stochastic, RSI, MACD, crossover, anything. We can also use relative strength to help us determine when to take profit on a certain stock. This is the same divergence signals as I showed you when we had a short entry. So the same theory applies, that this new high is not supported by relative strength. So we can decide when we see that gap down after that sell bar at resistance to take our profit. Another way to use the relative strength for profit taking is by adding two MAs, a shorter term and a longer term. This gives you an objective way of trailing your stop and getting the maximum profit out of a stock. You see the shorter term crossing down through the longer term MA. Normally this would trigger a sell signal, but this is a crossover of MAs on relative strength and not on the stock itself. This tells us that the relative strength is weakening. The stock is not as strong against the market as it used to be. But it doesn't mean that the stock will drop. So in this case, you should be looking into selling into strength of the stock on next rally, because you know that will probably underperform the market in the future. So that's your heads up that you should be looking to book profit on the next rally. This ends today's video. I hope you enjoyed it. Remember to subscribe to the channel so you don't miss out on future videos.